today I'm going to show you a secret tool that the ultra wealthy use in order to keep their mortgage payments super low and how you can use it too. What's going on, guys? I'm Keaton. I'm a loan officer from San Diego, California. And on this channel, I help people just like you learn how to buy their first home and build wealth with real estate. So interest rates have been on a crazy rise over the last few months. And if you're trying to lock in a lower rate and lower payment, there is another tool that's available to you, but not a lot of people are talking about it. Now, most people, when they opt for a mortgage, they're usually thinking about a traditional 30-year mortgage, or maybe if they're trying to get a lower rate, looking at a 15-year loan in order to pay it off a little bit faster. But what if I told you there's a way you can get the best of both worlds, where you can lock in a low payment by amortizing the loan over 30 years and also getting a lower rate? So what other kind of mortgage is out there? Adjustable rate mortgages, or ARM for short. Now, why are not a lot of people talking about adjustable rate mortgages right now? Well, for starters, most people don't understand them or understand how they work today. You see, when most people think about an adjustable rate mortgage, they think about the kinds of adjustable rate option ARMs that cost thousands of homeowners their homes pre-2008. But the kind of adjustable rate mortgage that's available on the market today is not the same as the ones then. And in fact, they're actually a lot safer than they've ever been. So for starters, what exactly is an adjustable rate mortgage? Well, for starters, as the name implies, it's an adjustable rate. It can adjust over time. The difference is with these mortgages is they're fixed for an introductory period, usually anywhere between 3, 5, or 7 years. And during that introductory period, it's usually fixed for as much as a full percent below what the average mortgage rate is for a 30-year mortgage. And then once that introductory period is over, then it can begin adjusting. So this kind of mortgage is becoming a little bit more popular right now because interest rates are rising really, really quickly, and people are still trying to figure out how they can afford their mortgage payments. So by having your mortgage payment fixed at a low rate for a shorter period of time, you're able to have a little bit more cash flow going on. And while having a super low rate and super low payment might sound really attractive, there's got to be a catch, right? Well, yes, of course. Once again, the catch is that after that introductory period, it can adjust. But there's some big differences between these adjustable rate mortgages and the ones that your mom and dad might have taught you about back in 2008. For starters, these adjustable rate mortgages are fully amortizing. Often the mortgages that people refer to as adjustable rate mortgages in the past were only interest-only mortgages. So you're only paying the interest on those. For the majority of mortgages today, they're fully amortizing, meaning you're paying both principal and interest down during that introductory period. This is a really helpful tool for people as well who are trying to pay down their balance as fast as possible because you'll get a lower interest rate, which means less of the payment is going towards interest, and you can start contributing more to paying down the principal balance. Another big difference with adjustable rate mortgages today is that there's actually limits on how much it can adjust. Typically, once the fixed period is up on a mortgage, it can only adjust once per year and up to a maximum of 1%. On top of that, it can't just go crazy and increase as much as it wants to. There's also caps on how much it can adjust above that original interest rate. So for example, a common kind of adjustable rate mortgage is a 2-2-5 ARM. So a 2-2-5 basically just breaks down the initial adjustment, subsequent adjustments, and a lifetime cap. So the first number represents the initial adjustment after the introductory period. So for example, let's say you had a 3% interest rate in your introductory period, and the initial adjustment can go up as much as 2%. So the most you'd be able to go up is from a 3% to a 5% in that initial year. And then that second number, that next two, represents subsequent adjustments. So the most it can adjust after then is another 2%. And lastly, the lifetime cap. The lifetime cap in this example would be 5%. So the most it can adjust above the initial rate is 5%. So once again, in this example, if you had a starting rate of 3, the most it could adjust to is an 8% interest rate. Now here's the catch. Those adjustments aren't based on whatever interest rates are at the time that the adjustment happens. So for example, just because interest rates are 5% during the adjustment period doesn't mean that your interest rate would be 5%. When the rate adjusts, that adjustment is based on a index plus a margin. Some of those indexes that are used are pretty stable indexes, honestly, and don't fluctuate as much as mortgage rates. Some of the common indexes that are used for adjustable rate mortgages include the SOFR, the COFI, and the CMT indexes. So every time your interest rate changes, your lender is going to use whatever this index is and the amount of change in order to figure out what your new interest rate will be. So what sometimes you'll end up seeing is even though mortgage rates might be high at the time of the adjustment, based on the index, you might actually get a lower rate. Now, another big difference with these adjustable rate mortgages versus the ones in 2008 is that back in 2008, they would use that initial payment to get you qualified for a mortgage. However, today, adjustable rate mortgages are qualified based on the maximum adjustment. So once again, going back to that example, you wouldn't be qualified based on that 3% interest rate for the starting period. You would actually be qualified based on the maximum adjustment of 8%. So if you don't qualify at the maximum, you actually can't get an adjustable rate mortgage. So for a lot of homeowners, this is a welcome change because they know based on their current income today that they'll be able to afford it even if it maxes out. So why should you consider an adjustable rate mortgage? Well, for starters, right now, especially with all the volatility in the market, it can give you some sense of short-term stability. Typically, if you're somebody who has stable or increasing income and you know you're going to be able to afford that adjustment period anyway, and you'll be able to afford it even if it maxes out, being able to lock in a lower rate and a lower payment for at least a short period of time while the market figures itself out can be a very attractive thing. This obviously frees up a little bit more of your income on a monthly basis to do other things, maybe repairing the home, maybe investing in some other places because the market's kind of crazy right now anyways. But at least in that short introductory period, you're going to have a really low payment. Another person who I think should use an adjustable rate mortgage is somebody who's going to be selling their home before the introductory period is over. The reality is most Americans who have starter homes usually don't live in their home for longer than 5 to 7 years. So taking out a 5 to 7 year adjustable rate mortgage when your payment is fixed for those 5 to 7 years, you'll never see that adjustment actually ever happen because you'll probably sell before then anyways. But at least in that short period of time, you're going to have a really low rate and a low payment. So this will let you do two things. Number one, you're going to have more cash flow on a monthly basis because of that low payment, but that lower interest rate as well is going to help you pay off more of that principal balance. So when you do decide to sell, you're going to make more money. Now, with all the benefits of an adjustable rate mortgage, I would be remiss without saying that there aren't some downsides. And of course, there are some certain people who should not get an adjustable rate mortgage. For starters, I'm very aware that qualifying for a mortgage and affording a mortgage are two very different things. So just because you qualify for an adjustable rate mortgage, if you absolutely need that rate and payment to make your budget work, I don't recommend it. Because if you're barely squeaking by with the budget right now during that introductory period and you have no plans on selling afterwards, you're going to have a harder time once that payment starts creeping up. Additionally, if you plan on keeping this home as your primary residence for all 30 years, an adjustable rate mortgage might not make the most sense for you either. On one side, you could always refinance if rates do dip down, but if we get into a situation where rates never come back down again, this can put you in a pretty tight spot if it continues to adjust. And lastly, if you don't have stable income or maybe unpredictable income or maybe not a super steady job, an adjustable rate mortgage might not make the most sense for you either. For example, if you work a job where your sales are more cyclical and based on certain things that you can't control, I don't know that an adjustable rate mortgage would make sense for you because it's going to be a little bit harder to deal with during that introductory period if your income is also as unpredictable as those indexes. But don't just jump into an adjustable rate mortgage because the rate sounds good. You want to make sure that it's going to make sense for you, not just now, but with your long-term plans for that property as well. But ultimately, I hope this gives you guys the knowledge that you need to know before you owe on an adjustable rate mortgage, if that's something that you're planning on using. And remember that mortgages aren't just debt. They're a tool that can help you leverage property and other people's money in order to achieve your dreams. So let me know what you guys think. Does an adjustable rate mortgage make sense for what you're trying to do with your property, or are you going to stick with the more traditional 30-year fixed? Let me know in the comment section down below. And as always, I hope this video brought you guys a ton of value. Hope it helps you along your home buying journey. If you have more questions, leave them in the comments. Here's a few more videos that I think are going to help you out during your home buying journey. And if you want more content just like this, remember, hit that like button and hit subscribe so you can stay up to date with all of my latest content. Until next time, see ya.